Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from 23 years in the game, so you skip the mistakes we made and go straight to property investment success. Welcome, Jez.
Thanks. Really hot topic, this one.
Free data versus paid.
Yeah.
I can't wait for this.
Yeah, this one gets me itchy.
Well, this was one of top of my list when I'm sort of trying to plan some of this content, thinking free data versus paid had to be up there. So, but before we jump in, let's discuss a comment that we received from one of our viewers. So we'll bring it up on the screen. So if you are watching this in video format on any of the platforms, you can obviously watch it. But we'll read it out anyway. So it's from Luke Pawolski 6446. So it was based on our last episode.
Yeah, so we did episode 6, which was about should you pay for, let's say you've got $1 million budget, do you buy $1 million asset or do you buy two $500,000 assets? And we were saying things like, well, first of all, you can diversify. Diversification is a great one. You can buy two properties in two completely different cities. We also mentioned the yield's higher for cheaper property.
And it can give you maybe some options. I think they were the three things: the diversification, the yield, and most probably if you did sell down at a later point, if you've got those lower price point assets, you can liquidate a little bit easier.
That's right,
compared
you've got
to
flexibility.
Flexibility, yeah. So that's the main one. But look,
Luke Pawolski 6446 put some good points in. Let me just read out what he said. He said, "Thanks guys, very valid points, but shouldn't there have been a focus around the points below? Less maintenance, less managing fees, less headaches, less to go wrong, less insurance, landlord and home, one less tenant, more demand with population growth increasing and wealth increasing over time." Thoughts?
And I must apologise to Luke. I accidentally deleted the YouTube comment. Luckily, I pasted it into Word. But apologies, Luke. I did delete the comment. But so I guess less maintenance, valid point.
Yeah, that is a good point.
You've got one property, so more than likely you've got... I guess that valid. It's definitely valid there. Less management fees. I guess with the higher price point property, the yield might be lower. And let's just say the management fee is 7%, and then you got those two properties, the yield's most probably higher, so you're getting better cash flow. But then the management fee might be higher depending on the portion on the yield. So
yeah,
give a take on that one. Less headaches. Agree. Less could go wrong. So I think this is more probability. Having two properties, the probability's higher.
Yeah, well, let me tell you, when I had 16, I had a lot of headaches. I mean, it's good. You're obviously getting, I'm in my acquisition stage. When you're sitting there and just collecting capital growth, it's obviously better to have 16 than one. But if they were all in the one spot, oh man, that would have been, a lot of eggs in one basket.
And I remember when you were doing like a lot of your paperwork, you were stressed. I've got to do my tax return.
That's right. Yeah, putting in into a spreadsheet all of those, like 16 investment properties, all the details there. I think he's got a good point there. Less headaches, but what is your time worth? What is a headache worth? You got to put a dollar figure on what a headache is.
That's just getting a good property manager and ensuring that you get the right tenants. I think that's the main thing.
Hey, do you pay your own council rates, or do you get your property manager to do that for you?
The council rates
and insurance.
The council rates, I do the insurance.
Right.
The council.
I used to pay everything myself. Now I just send everything to the property manager.
Yeah, the council rates. I can't remember. I think I do the council rates. So, but again, you can give it to the property manager, and then I think the other thing is I've got less insurance, one less tenant. Valid points.
Yeah.
And this is a good one though. More demand with population growth increasing and wealth increasing over time. Now, this is a good one.
Yeah, this one. This one winds me up a little bit because I've done so much research on this. The more affluent areas, the more expensive property markets, particularly closer to the CBD, historically they do not have more demand, more capital growth. So you need to draw a distinction between wishful thinking and demand. So demand is like the demand we're interested in is the demand that will push up property prices. So someone putting their hand up at auction, increasing the bid, making an offer, pushing prices up. A 14-year-old boy might want a Ferrari, but that does not influence the price of Ferraris because they don't have the financial capacity to push up prices. They're not going to walk into a dealership and start negotiating. So you need to draw a distinction between just aimless desire. Picture a $150 million mansion in Point Piper. Yes, everyone would like to live there, but is everyone going to push up prices? No. So these areas are not always in higher demand. And they don't always, there's also another myth there about population growth. It has very little influence on capital growth. Even higher incomes, wealth increasing, an increase in income hasn't shown to have a significant impact on capital growth. So the last points I would object to, but definitely the all the others, less maintenance, less headaches and all that, I think he's got valid points there.
And, I wanted to make a point that with the council rates I do through the property manager, just make it a little bit easier, but the insurance I tend to just pay myself and put it on the spreadsheet. But look, I purchased a property back in, June 20, 489,000, built in 1962. So an older property, 650 square metres, spent about 15,000 cleaning the property up, building in pest, making sure that property's fine structurally. There's a granny flat option, potentially something that I'll do maybe later on down the track, but in 3.5 years, guess how much I've spent on repairs? And you know the answer because we sort of went through this, didn't we?
Do you remember? I'll look at the notes here. You've written it down.
Don't look at the notes.
I reckon it was $1,300 in 3.5 years.
Exactly. 1,300 in 3.5 years.
Yeah. Okay. Well, that's normally I would factor in like 1,500 in a year for a typical sort of established property.
I think good property manager, good tenants. If you do buy those lower priced assets, you should be okay. I think it's more the diversity.
Yeah, a lot of people do worry about cheaper areas that you've got a lower socioeconomic demographic. They're just kicking holes in walls. They do the runner, that sort of thing. So my approach to that is, number one, obviously landlord's insurance. Number two, get yourself a good property manager. And number three, don't get too aggressive with the rent. So if you're going to rent it out and the property manager says, I think you get $500 a week for this, you just say, well, let's put it on the market for $485, see how many applicants we get, and then you just pick the applicant that's got the best, longest track record of renting, and they're more reliable. And then you've got less to worry about then. You've got less headaches. But all of these things are just 1%ers,
Thanks for the comment, Luke. I think it was good.
Yeah, good one. Thanks,
Great.
Luke.
So let's jump into the main topic. So free data versus paid. So, Jez, what is property data-driven investing?
Yeah, so, why would you want property data? So what we're talking about here is data-driven investing is instead of going off someone's opinion or hearsay or reading tea leaves or looking at cloud formations, tarot cards, we're actually looking at historical data. What does the historical data say drives property prices? And so we're making an informed scientific decision on where to buy using the best data we have available. So that's what we're talking about with data-driven investing.
And you hear it thrown around a lot now, don't you? Data-driven, data-driven. Everyone's, which is could be seen as a bit of a marketing angle just to get the leads in. But I first started hearing about data back in 2014 when I was sort of learning and listening, and it was actually Ryan McLean on property. Uh-huh. So I actually really enjoyed listening to his content. And I heard you on one of the podcasts. I'm like, oh, this guy isn't too bad. And then I really liked the data aspect because I was getting mixed signals and messages from all these experts out there, and I had no idea. I'm like, where do I go? So I think the data just, for me, made me understand a little bit more that if I am going into pockets, I want to use some type of information to, depending on where I'm going to invest, I need some data.
Yeah, there was, back then, that's a fair while ago. Back then it was really just data. Like there were one or two people in, say, 2014 that were pushing data, and everyone else was just all opinion. All these old schoolers, yeah.
I remember it was about 6 months ago, I sent you I shared a post with you on Instagram, and I couldn't find it, but someone mentioned that they're, I think a buyer's agent, data-driven, and they mentioned that they were best friends with Jeremy Shepherd. I'm like, good, best friends? Good. What's this? Like, Jeremy, do you know this guy? And I sent you the post, and You didn't know him, did you?
Yeah,
So they were throwing your name around.
I couldn't remember.
I just
anyway,
laughed. I
if
saw
did
this
know.
Jeremy Shepherd. What? But okay, so what's the difference between free and paid data in property investing?
Yeah, so I'm a big believer in getting the best data, paid data. Now, there is some good free data out there. For example, ABS data, probably the most reliable data, well vetted, a lot of experts there that make sure that whatever is published is really good. So ABS, thumbs up. And then at the other end of the spectrum, I have seen some free data, which is just, even though it's free, it's overpriced. It's going to cost you. You base an investment decision for, say, a $500,000 property using some bad data, and that's going to cost you tens of thousands of dollars. And I'm always amazed that people don't want to spend a couple of $100 on getting some good data, at least some decent data, when they're going to invest like hundreds of thousands, if not millions of dollars.
Do you think they use the free data to get clients through?
Oh, yeah. In fact, I used to work with someone who said, Jeremy, it's just a lead magnet. Just a lead magnet. DSR is just a lead magnet. And yeah, I won't talk any more about him.
But because it's like you think it's to get clients through the door, and look, potentially a client could be worth what, 50 to 100,000. You get them in maybe, well, think about it, maybe mortgage broking. Let's say they use a buyer's agent 3-4 times, maybe some planning, maybe some financial planning, referrals, whatever it might be. So they obviously say data driven. And
you've got to say data driven to get them in the door, don't you? Yeah.
And then, but look, at the end of the day, you just need to do your due diligence. I think that's what we really want to make sure we get that point across is not everyone's bad. We just want to make sure we're a bit skeptical, and you should always come from that angle.
Yeah. And then on the other side, I mean, obviously we make a buck out of selling data. So we're a little bit biased in that respect. We're obviously going to pump up the data and say it's really important.
But when you're shortlisting a suburb, let's say you're paying $500,000 to $1 million, you need to do analysis around that, and we'll talk more about that. But
yeah, well, one of the examples I give is, I'm surrounded by a lot of data. I obviously use data to make decisions for myself. If I had one single extra metric that I knew was going to improve the performance of my property that I'm about to buy by only 1% and only for 1 year, if that's a $500,000 property, then that data is worth $5,000 to me. So how much would I pay for just one additional metric? I'd easily part with $1,000. And in a year, I'm better off by, well, I've got a 5,000 return on that investment. That's a fourfold return, 400% return on my investment. So why wouldn't I spend it? That's better than the investment I get from investing in property. So yeah, to me, data is ridiculously cheap.
It just gives you a bit of that confidence, doesn't it? And I think back to that point about the free data, they get your email. A while back, I put my email address in. I got 15 emails within 3 days. I'm like, really? 15? It's like, just relax.
Yeah, relax. Yeah, one of them, they insisted on my mobile. And I ummed and ahed about it. And in the end, I gave them my mobile. And every day now, several times a day, the operating system is banning this. You're getting a call, but it's suspected as spam. I can't remember what the message is.
Just hit the block.
Yeah,
So how does free data compare to paid data?
Like in efficacy, I would say there's some good free data out there.
Because you think there's a lot of data, like how many companies, I've got data, this got data, like how would you...
So first of all, what is it? I mean, some of it can be absolutely useless, as we've shown in the expert busting series, and some of it can be useful but is tainted. I've seen a lot of reports by property developers that it's like they only show the good things about this area, not any of the bad things. And of course, they've got a hidden agenda. It's more marketing. It's not really all of their research went into the feasibility study. Now it's marketing. Hand it over to the marketing team. They just Google anything positive.
Well, they can maybe find that, put it in their report. So let's just say, we'll use Melbourne as an example. Like Melbourne's a hot spot, but their service is just in Melbourne and nowhere else. They're not looking in all the other states. Because really, you want to be able to go anywhere, not just go into specific one area.
Yeah, borderless
investing. And what are the pros and cons of free and paid data? So I'll start with this one, maybe the level of care.
Yes. So, I mean, there's this one data provider, for want of a better word. They've got an algorithm, they've got all this data. And I checked out their website not so long ago, and some of the yields they were publishing were just absurd. And I went to those suburbs, checked some stuff on real estate and on Domain, and they clearly do not care about what they are publishing. It is just a lead magnet.
And the other thing is, I guess what's a con of any sort of data? I know originally for me, it was maybe the analysis paralysis. That would be one thing. The other thing is also the data can change month to month. So you can look at 1 month and another month and the stats can be a little bit different. And the way I negate that is I look for my clusters, trends I also like to potentially look at, because when I'm spending that much money, it's hard to sort of get in and out. Ideally, you want to get that capital growth as quick as possible. That's the whole idea, isn't it?
Yeah, so what you pointed out there, I checked the historical chart. Things like vacancy rates, very volatile. So you might be looking at a 0.5% vacancy rate this month, but last month it might have been 2.5. In very thinly traded markets where there's hardly any landlords there, you'll see that volatility. So the easy check is the historical chart. And like you said, looking for clusters. So it's not just an isolated one-off suburb. There's a bunch of other suburbs that have the same heat in that market.
And you can use it to, I guess, what the value proposition in, I think we've mentioned it before, that you're spending this much on an investment property, let's say 500,000. What's wrong with paying for a little bit for paid data? And we do have a business, I get that. But I would like highly recommend, look at other companies. Like, what is our data the same as someone else? Why are they different? Because I wouldn't look, as I said, that one suburb in isolation. I'd look at maybe even an LGA. That's me personally.
Yeah.
Because
Aggregate.
one suburb, anyone can pump up that one suburb, but I like to see
an entire area that's got some heat in it. Yeah.
Well, if there's some heat in there, and then you can look at surrounding areas. You can look at Google Maps. You know, is there any supply risk? Is stock on market percentage high? Is there that ripple effect potential? So there's a lot of variables that you can sort of dive into, which you won't do in this episode. But
and what you were saying before about the price for data, and I don't want to pump up our competitors, but data is so cheap compared to the benefit that you get from it that you could pay to get all of it from even our competitors and us, and you're not wasting your money.
The thing is, if you do go through, that's a good point, but if you do go through like a buyer's agent or you're going through that process at the moment, maybe look at some different data sources and push back on the buyer's agent. Like, what are you actually looking at? There was one, I won't name the name, but you give the email and you see these videos saying they got this algorithm. No one can predict the future. What you can do is increase the probability. We're not perfect, and I'm happy saying that, but we can increase the probability, and we can do that via the data. But when I start hearing these algorithms called Betsy or this and that, trying to find these areas, like, I get frustrated. It makes my blood boil because they're really in your face and you get 15 emails. It's just, take it easy.
I've been in the industry long enough to see the telltale signs of someone who's focused more on marketing than on product.
But 10 years ago, I most probably would have been a sucker for that.
I was too. 2008, I got sucked into buying in an area which was just very well reported, just very convincing words from someone who's just straight up and down fake expert, and got burnt.
Well, you purchased the property, didn't you, based on reports and data, and that property did nothing for years.
15 years. It was almost 15 years to date, and that market is still backwards from where it was in 2008.
So it's not a great story, but you learn from that, don't you? Learn.
I've calculated it was an opportunity cost of about $1 million. Yeah.
And there's no repercussion for that?
No, that guy is still selling reports and highly revered in the industry too.
I don't get it.
Yeah.
I think there's definitely in the future there needs to be some sort of accountability. Like I said, you are taking a risk investing. I get that. But when you're paying big money to someone, there needs to be some sort of accountability in the industry. And at the moment, there's really not, is there?
No. And like I was saying before, some of them are just, as soon as I see someone whose marketing is really excellent, straight away that starts triggering alarm bells.
Ding, ding, ding.
Yeah.
So I guess, how can you use data to tailor your needs? Do you think, like for anyone listening, like how do you use it?
Number one is budget. So you would search or filter according to your price range. I can only afford $450,000, so you would use some data to filter through the suburbs of Australia. So
you have a strategy in place and you work, okay, $450 is the price point that I can afford. And from then on, you can go, okay, let's look at the data or look for suburbs at that price point or below potentially, or in and around that number.
Yeah, so 450, for example, right now, that filters out a lot of suburbs around Australia.
And the other one is cash flow, so yield. You can filter by yield if you need strong cash flow.
Yeah, that's right. If your mortgage broker has told you, look, it's a bit tight here, you probably want to start thinking about cash flow there. Or maybe you're nearing retirement, so cash flow is a big consideration. But the big one, of course, is the capital growth, and that's what you're using data for.
And the last one, risk, I would say.
Oh, yeah. So if there's not much data on a suburb, that's a risk. Risk is ignorance, what you don't know. What you don't know will hurt you.
And do you think you can balance free data with paid data?
Right, yeah, interesting question that. I'm of the opinion that we are getting very close, if not already at a point where you really need to rely on what an algorithm is telling you. If you try and complement it with some of your own data that you gained by some free source, you could undo the work of the algorithm. What's your spin on it?
I think it's good maybe potentially for a sense check. Like I said, you might use our data, you might use someone else, you might look at free data, you might go to 3 different avenues. If I'm going into a pocket, I'm going to spend a lot of money on this property and I'm going to hold it for a long time. You might go to 3 different data sources and say, do they all say the same, or do 2 say the same and 1 doesn't? That's like, for me, it's maybe a bit of a sense check potentially.
Yeah, it's interesting you put that. Like, how long are you planning on holding this property for? 10, 20 years?
Lifetime for some.
$500,000 property, but you don't want to spend $500.
For some people, it's a lifetime. Like, they hold it the long term. They take that passive income off it. They got that exposure to property forever, and then they might have their super and share portfolio generating money from dividends as that other inflow.
It is a big investment.
I think the other thing is, so what are your thoughts on, I think I asked you this a while ago, trends?
Oh, yeah, trends. So I have a mixed sort of review of trends, but I have this statement: every time a trend extends, you're one step closer to that trend's end. So trends don't last forever. Every day is a new day. That's a trend we've been seeing for a very long time. It probably will go for another few billion years. So you generally bet with the long-term trend and be very cautious, or possibly bet against the short-term trend.
Yeah, I think the trends, I know, again, we've spoken about this a lot, but if I'm going into a market, I like to sort of see maybe the demand to supply ratio picking up for a bit and then jumping into a market instead of going, that volatility I'm very wary of.
Yeah. So a trend is certainly protection against volatility. If you see the DSR suddenly, demand to supply ratio, if you see the demand to supply ratio suddenly spiked, it could be a one-off or it could be the start of a trend. So if you review the historical chart, at least you can verify whether it's been trending upwards or a one-off.
So I think with the data as a summary, it can help with shortlisting suburbs to invest in.
For your sense check, yeah.
Reduce risk.
Yeah, you can pick out high cash flow as well.
And I would say with a lot of clients that I've worked with, it's also reviewing an existing property. So you hear a lot, just hold forever, never sell. Where I would argue that if you've held a property for 5, 6, 7, 8 years and it's done 0 to no growth or gone negative, you need to talk to a professional and make a decision on, do you hold this property? Do you sell it? Is there opportunity for any growth?
Yeah.
Because the thing is, if it hasn't had growth, it might have growth in the near future.
It might be about to boom, but how do you know that? Or is it just a forever dud? Yeah.
But I've seen like high rises in Docklands, in Sydney, not so much, but more like Docklands, maybe Melbourne CBD, Fitzroy, like those 1-bedroom apartments that, clients would come through and they have gone backwards. So sometimes you just need to cut your losses. West Footscray is another example. Cut your losses and then just go, okay, start over. There's nothing wrong with that. And look, you do take a hit, so you have to do your numbers, because the last thing you want to do is sell and then you can't get back in.
That's right, yeah. Now you're out of investing entirely. Yeah, and I took a hit when I sold that property that I bought in 2008 in that diabolical location. And it's a sort of a wake-up call, and you learn from that if you can admit you made a mistake. So it is beneficial.
Takeaway points for our listeners?
spend all your money on our data.
No. Just respect the data.
Respect the data.
Respect the data. So where can listeners go for more resources?
Yeah, well, if you found this episode insightful, let us know, because we can bring more of those. So click on like, and of course, if you subscribe, you'll get sent more.
Yeah, that's right. Subscribe, like, share to the world. And thanks for tuning in, and see you in our next episode. Bye for now and take care.